Good morning, good afternoon, and good evening, wherever you are in the world when watching this webcast. Welcome to the second of the three webcasts on the Exposure Draft Subsidiaries without Public Accountability Disclosures. The Exposure Draft was published by the Board in July 2021 and sets out the proposal for a new IFRS standard that would permit eligible subsidiaries to apply reduced disclosure requirements when applying IFRS standards. I am Carla Pereras, IASB Technical Staff and Project Lead. I am joined here today by another member of the project team, IASB Technical Staff, Hazira Hasni. In our first webcast, we explained why the board undertook the project, the objective of the draft IFRS standard, and which subsidiaries it proposed to apply the draft standard. In this webcast, we will discuss how the board developed the proposed disclosure requirements. Our third webcast will discuss the structure and application of the draft IFRS standard. And with that, Hazira, can you explain the board's approach to developing the disclosure requirements?
Thank you, Carlo. In developing the disclosure requirements, the board borrowed some thinking from the IFRS for SMEs standard. Why? The board noted that it had already designed the disclosure requirements in the IFRS for SMEs standard by reducing the disclosures in IFRS standards so that they met the needs of users of SME or non-publicly accountable entities' financial statements. Starting with the disclosure requirements of the IFRS for SME standard meant the board did not need to develop new disclosure requirements. The board could be satisfied that the disclosure requirements met the needs of users of subsidiaries' financial statements, as subsidiaries eligible to apply the draft standard can apply the IFRS for SME standard. Let's go a bit deeper. What does borrowed some thinking from IFRS for SME standard mean? It means that in developing the disclosure requirements, the board would first consider whether there are differences in the recognition or measurement requirements between IFRS standard and IFRS for SME standard. The board compared each IFRS standard individually with the relevant section of the IFRS for SME standard to identify these differences. For example, in considering what disclosures should be required for inventories, the board compared the recognition and measurement requirements of IAS2, the IFRS standard for inventories, to Section 13 of the IFRS for SME standard, the applicable section on inventories. In cases where there is no recognition and measurement difference between the two standards, the board used the disclosure requirements in the IFRS for SMEs standard, but updated them to align terms, languages, and update paragraph references. For example, Section 20, Leases, of the IFRS for SMEs standard uses the term contingent rent. However, IFRS 16, the IFRS standard for leases, uses the term variable lease payments. Consequently, when proposing disclosures for IFRS 16 in the draft standard, variable lease payments is used instead of contingent rent, the term that is used in IFRS 16. Where recognition and measurement requirements differ, the board used the disclosure requirements in IFRS standards, but tailored them by applying the principles it used in considering users' information needs in the IFRS for SMEs standard. Such a difference arises when there are topics or options omitted from the IFRS for SMEs standard, but are in IFRS standards. For example, the board needed to add disclosure requirements for subsidiaries applying the revaluation model in IAS 38, as the IFRS for SMEs standard does not include that accounting policy option, and hence includes no related disclosure requirements. Applying this approach allowed the board to develop the proposals in the exposure draft in a structured manner. In some cases, the board proposed exceptions. These are explained in the basis for conclusions of the exposure draft. Now, this brings us to the next question. What are the principles that the board used in tailoring the disclosure requirements in IFRS standards when there is a recognition and measurement difference? That is, how did the board reduce the disclosure requirements in IFRS standards? These principles are set out in paragraph BC 157 of the Basis for Conclusions on the IFRS for SMEs standard. They are used when developing the IFRS for SME standard to help reduce the disclosure requirements in IFRS standards by identifying what information is important to users of SMEs' financial statements. In developing the IFRS for SME standard, the board was guided by the following 5 principles. Information on short-term cash flows, obligations, and commitments, as this provides information on the ability of a company to meet its obligation. Information on liquidity and solvency, which informs users on the entity's ability to generate cash flows and continue as a going concern. Information on measurement uncertainties, for example, how provisions are measured or how impairment is calculated, and the inputs used in those calculations. Information about an entity's accounting policy choices, such as how you measure inventories or intangible assets, and disaggregation of amounts, like reconciliation of PPE or defined benefit liabilities. By using these principles, the board can be satisfied the proposed disclosure requirements satisfy users of eligible subsidiaries' information needs. As I mentioned earlier, developing the disclosure requirements involves comparing the recognition and measurement requirements of IFRS standards and the IFRS for SME standard. However, there are some IFRS standards that apply only in specific circumstances or only some companies are in scope. For example, IAS 33, earnings per share, applies only to companies that are traded in a public market. In developing the exposure draft, the board needed to decide whether to propose reduced disclosures for these standards. The board is proposing, for IFRS 17, an eligible subsidiary with insurance contracts within the scope of IFRS 17 would apply all the disclosure requirements in IFRS 17. The board made this conclusion after considering several matters. Among this is that IFRS 17 introduced a new model for insurance accounting, and users should be allowed time to familiarize themselves with the new model before the board proposes reduced disclosure requirements. For IFRS 8 operating segments, an eligible subsidiary is outside the scope of IFRS 8. If an eligible subsidiary disclosed segment information, it would apply all the disclosure requirements in IFRS 8. If the eligible subsidiary discloses segment information that is not consistent with the requirements in IFRS 8, the subsidiary has to disclose the basis of how such segment information were prepared. Similarly, an eligible subsidiary is outside the scope of IAS 33, earnings per share. If the subsidiary opted to disclose earnings per share, it would apply all the disclosure requirements in IAS 33. The exposure draft includes proposed disclosure requirements for all IFRS standards issued as at 28 February 2021, except for those I just mentioned as shown in the slide, and exposure drafts published as at 1st January 2021, except for the exposure draft on general presentation and disclosures. And with that, we have now come to the end of our webcast on how the disclosure requirements were developed. Let me hand you back to Carlo.
Great presentation. Thank you, Azira. The exposure draft is open for comment until 31st January 2022. For more information about the project, or if you want to submit a comment letter, please visit the project page on www.ifrs.org. As part of this webcast series, we also have webcasts on the following topics: the objective and scope of the draft IFRS standard, and the structure and application of the draft IFRS standard. Thank you everyone for listening to this webcast and for your interest in this project. See you at the next webcast.